Hello and welcome to myotherprofessor.com. Today's lecture will be on the stock market. We'll call the lecture Stock Market 101. Our focus will be to provide a very broad overview of the market. We won't discuss the details, we'll save those for other lectures. Ultimately, the purpose here for today is to introduce the concept of the stock market, what it does, and how we can profit from it and stay away from the dangers that exist, and some would say dangers which are inherent within the market. So we'll first cover the purpose of the market, and then we'll talk about where to invest in the market. After that discussion, we'll talk about how to actually go and invest, the mechanics of investing, and then we'll talk about controlling your expectations within the market. The idea is slow and steady returns versus shooting for home runs or batting for home runs. We want to stay away from that mentality. The ultimate aim of the stock market, there are many answers. Some would say there's speculating, there's a speculative nature to it. Some would say there's a gambling nature to it. Some would say that there's a hedging nature to the market. Overall, the purpose is we're looking to get a type of return which exceeds a risk-free return. In this case, we'll take an example of investing $100,000 in a bank CD. We may be getting 4.75%. So that gives you $4,750 a year at 4.75%. The idea is, where can I invest that money and try to make a return greater than that 4.75? Keeping in mind, any return beyond that 4.75 would be classified as a risk return. So keep in mind there are no risk-free return vehicles within the market, and anyone who tells you that you can invest without any risk inside the stock market is blatantly lying to you. How to invest in the market. You may have heard people saying, I'm invested in options, I'm invested in puts, I'm invested in stocks, I'm invested in ETFs, I'm invested in mutual funds. The answer is all of the above. The stock market is a very broad place in which you can invest in any instrument which suits your needs and your, we could call them your desire. If you like to invest in a vehicle that moves much faster than something else, there are things in which you can invest. So keep in mind, you get what you want. If you're looking for something slow, you'll find something slow. If you're looking for something fast, you'll also find something fast. The most common way in where people invest in the market would be the individual stocks market space. Let's call them, we'll call them individual stocks, and then we'll talk about ETFs in a second. Individual stocks would be, for example, Apple. Their symbol is AAPL. We all know about Google. The symbol there is GOOG. How about the ugly shoe company, Crocs, CROX? Walmart, WMT, it goes on and on. There's GE, Pfizer. Almost all the large companies that you know of have a presence either in the American stock market or domestically in their home country. So you get to invest in individual companies. Then you can invest in index products. Index products would be, basically think of it for a way for you to take $1 and invest it broadly over the entire market. So this way you don't have the risk of being exposed to one individual stock. Imagine, let's just take the $100,000 portfolio example. You have $100,000. You put it all in Apple. We're real excited. It keeps going up. Every 10% move is $10,000 in your pocket. It's very exciting. But you know that Apple can fall 10 or 15%, if not in a day, but over a couple of days or over a week. So that $10,000 to $15,000 you've just made could be gone equally fast. So the index product allows you to invest in the broader market. So that $100,000 invested would give you a market presence, but at the same time, you wouldn't have that much of a risk exposure. At this date, the stock market is down roughly 15% year to date. So if you had put $100,000 on the 1st of January in an index product, your stock would be worth $15,000 less. But if you were invested in any given number of stocks, you could be down 50 to 60%. So this gives you an idea that even when the market's falling, if you're invested in a broad-based index fund, an index ETF, you're not going to lose as much. And obviously when the market starts moving, you're not going to make as much, than say being in an individual stock. But the idea is you want to make more than that risk-free return, which is 4.75 we just talked about. And another way to invest in the stock market would be for you to buy mutual funds. Mutual funds, basically, they have fund managers who do the work for you. You send them money. They take that money and they buy individual shares or they buy ETFs. You get broad-based exposure, and you don't get to do much of the thinking. And of course, for that, they charge you a small amount of money, which would be their fee structure. So pay attention to that. The basic nuts and bolts of the market: research and education. Don't fool yourself. The market is not easy. It seems very easy. There's really no hurdle. You know, you take some money, you plunk it down, you say, "Hooah, I'm invested." It doesn't work that way. You know, that's a gambler. That's going to Las Vegas. Friends of mine say, you know, if you want to lose money, you might as well go to Vegas because you'll have fun losing it. If you want to make money in the market, or you don't want to lose a lot of money in the market, you have to spend time doing research. You have to spend time educating yourself. You have to have patience. You've got to use your brain and then ultimately combine all these things together and execute either by buying the stock or selling the stock.